if I buy a $500,000 worth of property under a business, like a property that is a business property, not personal, and sell the entire business before it hits the 3 million with all of the assets, is this tax-free? Now, generally, no. However, if you are a business owner and you meet certain criteria in the small business CGT tax concessions, then it can be tax-free or get up to a 75% discount. I'm going to run you through a bit of a scenario of how. Now, some of you may have heard me talk about the small business CGT tax concessions as one of the best cheat codes that you can use as a business owner in order to build tax-free wealth, or at least significantly reduce your tax liabilities as you grow and scale your business. And basically what this involves is that if you run a business and you meet certain criteria, your revenue is under $2 million or the asset value is less than $6 million, you've been running the business for more than 15 years, you meet certain age criteria, there's a number of other qualifying criteria. If you sell the business, then you have the ability to have a significant discount on the capital gains tax, or in some cases have the capital gains tax reduced to zero. I recently sold a business for multiple millions of dollars and I paid $0 in tax as a result. Now, one of the conditions of that is what's referred to as the active asset test. And essentially, if you have an active asset, being a commercial property that is used in conjunction with your business, then that particular asset can also form part of the CGT discounts. So let me give you a little bit of an example. I have a client recently who was running a hospitality business where they owned the venue. They'd bought the business for $2.5 million. They scaled that business up to $5 million over the space of about 3 years. And they sold that business along with the real estate associated with that particular property. Now, because they were over the age of 55, because they were intending to start another business, and because the asset was an active asset in connection with the ongoing operations of the business, we're able to apply a number of CGT discounts. One, we're able to apply the active asset discount, allowing us to apply a 50% capital gains tax discount on the sale of the business and the property. Two, we were able to contribute a significant amount to superannuation under the retirement concessions because they were over the age of 55. And three, they were able to claim a further discount because they'd owned the business for over 12 months and they'd run the business through a trading trust, which then allowed them to further reduce that. And then the last consideration is that because they were going to go and buy another business, we're able to roll over the residual amount and essentially pay zero tax on that transaction. So the important part is as follows. One, you need to get advice around this. Having this structured incorrectly can result in you losing all of the concessions. And in some cases, you only get a partial concession compared to getting access to a complete tax-free sale. Two, you need to make sure that you've got the appropriate entities in place. In that particular instance, because we knew the client's goals and objectives, we gave them advice around setting up a trading trust, where other businesses would have been running through a proprietary limited company and maybe wouldn't have got access to the further 50% discount on CGT, and that could have resulted in them being left with a tax bill. And three, you need to have an appropriate timeline to do this. You need to start with the end in mind. So if you are planning to build a business for sale, then we need to understand, should we be buying that real estate in direct connection with the business itself, or should we be buying it through a separate entity and then having a leasing arrangement and having it disconnected from the operations, or should we just be renting? There's multiple strategies and considerations that need to be made to ensure that you can get the best possible tax outcome. We don't want to just do things for the tax outcome. We want to do things because they make sense. But if we can couple that with a really great tax planning strategy, then there could be savings in this particular client case of hundreds of thousands of dollars in tax as a result of implementing the right strategy. So it pays to get good advice.